So despite today's stock rally, the averages are still down about 7% or more in June as inflation has surged to 40-year highs. In a speech yesterday, former Treasury Secretary Larry Summers laid out 3 potential scenarios to bring inflation down. Okay, here's your choices. 2 years of 7.5% unemployment, 5 years of 6% unemployment, or 1 year at 10%. So which one would my next guest prefer? Jeff Krumpelman is Chief Investment Strategist at Mariner Wealth Advisors. Jeff, welcome. And which door would you like to open, sir?
Well, quite frankly, all 3 doors sound quite horrible. I don't think I would subscribe to any 3 of those doors. And all due respect to Larry Summers, you know, what a brilliant guy. And very articulate. But there are plenty of folks, and this kind of gets into the bear and bull camp on the economy right now. You know, Ed Yardeni is an example of someone who says, you know, that we can have a soft landing. The Fed can still engineer that. And we think that's possible. But if they cannot do that, we're talking about a mild recession. And the 3 cases that are outlined right there, 10%, you've hardly seen that in the history of the world. You're talking about depression era levels. And then the other 2 are quite high. I'd like to take a look at over time and just see how extended you get those levels of unemployment. We think that the data is not that negative. It just isn't improving as fast as people want. And so the market's already discounted. I think a mild recession, if you X out those extreme situations that Larry seems to want to describe, the S&P 500 in a mild recession tends to be down around 25% on average. We're almost there. I don't think it's a time to be negative. I think it's time to say, when is it the time to buy? Not quite yet, but pretty close.
Well, and coincidentally, you know, it wasn't just Larry Summers. Goldman over the weekend doubled its recession odds. They said basically the Fed has now front-loaded more of the rate hikes, leaving less possibility of that soft landing that you talked about. But I wonder if underlying what Summers is trying to say, and even what Goldman's indicating, is that you could get a softer period for the next little while, but it's going to be more drawn out. You know, is there something to this idea of much tighter policy? Okay, you get a much worse recession, but hopefully it's a shorter one followed by a stronger recovery.
Well, I think that it will take some time to churn. I think that we're in a period, I don't think it will take excessively long for the market to recover. I think by the end of next year, we could see the S&P 500 and 5,000 that is significantly above where it is now. And I'm talking about, you know, mid to late in the year. But I think we need to see right now what's happening is inflation news is not as bad as the headlines suggest. There are signs that it is calming a bit, just not as fast as everybody wants. And I think the Fed, look, we're not even at neutral right now.
Right.
And folks are acting like we're going to restrictive. It's very possible that, you know, when we've gotten some of this data that the economy and retail sales and housing, it's already starting to calm. That will improve the inflation data. And I'm renovating a house in Cincinnati, Ohio. And my contractor, you know, as we were going through the budget, and we don't like to go over budget, as you know, as consumers, you know, he said lumber prices in the last 2 weeks, you know, they've declined almost, you know, by 50%. So, Jeff, calm down. You know, maybe the labor hours are a little bit longer as you make some changes to what you want to do. But some of the materials costs are coming in. So let's just see what happens here. Don't predict the predictors. Let's listen to the market. Let's listen to the economy and tell us where the trend is.